Good morning, friends. This is Kaustubh Pawaskar, Senior Research Analyst with Sharekhan by BNP Paribas. Today, we will discuss one of the top ideas in the healthcare services space, that is healthcare global enterprises, which is one of the best oncology service provider in India, healthcare service provider in India. So it is a comprehensive hospital chain with a scalable business model. It has around 22 cancer care centers in India, highest among the large hospitals. It has around 30 radiation equipments, which is highest again if we compare to one of the large hospitals like Apollo Hospital, which has around 17 radiation equipments, and 1.6 times footprint compared to the large multi-specialty hospitals. Its unique business model stands it at top amongst the multi-specialty healthcare service providers. So some of the key unique parameters are end-to-end cancer service services under one roof, that is from diagnostic till the post-care services, strong research capabilities leading to better outcome, around best-in-class equipments, that is around 30 Linacs compared to the Apollo Hospital having around 17 Linacs, 3 robotic machines which gives a better diagnostic and treatment therapy for the cancer patients, and its focus on asset-light model. So these are the key differentiating factors which is standing out for healthcare global enterprises. And in past few years, we have seen companies performance has seen a good turnaround in terms of revenue and profitability. So its revenues grew at a CAGR of 13% over FY 2019 to 2022. So new registration, increase in capacity utilization under the existing bed, new capacity addition. So these are some of the drivers which aided company to achieve a good growth, and also this will help company to maintain the double-digit revenue growth momentum in the coming years. So we are anticipating around 16% revenue CAGR growth over FY 2022 to 25. Its EBITDA margins have consistently improved. So it has improved from around 14% in FY 2018 to around 18% in H1 FY 2023. Around 85% of its revenues is coming from its mature hospitals, which has already have EBITDA margins of around 24 to 25%. Some of its new hospitals, like one in Mumbai and Kolkata, which contributes around 15% of revenues, they are yet to attain the scale, and hence the new hospitals EBITDA margins are at around 10%. So once these hospitals attain certain scale, the EBITDA margins of this hospital will also move up to around 20% level. So these are some of the drivers which will help overall EBITDA margins of the company to inch up to 20% by 2025. Also, company has tied up with external consultant to provide 100 to 150 bps or kind of a cost efficiency, which will further add on to their margins in the coming years. So company is quite confident that they would touch 20% EBITDA margin by FY 2025. So strong profitability, asset-light model with lesser capital allocation towards the lesser capital allocation will help the company to see consistent improvement in their RoCE. So we are expecting companies RoCE to improve close to 20% in another 3 to 4 years. The company does not have any major capex plan except for two facilities which are coming up. One in Ahmedabad, which is the extension of its existing hospital where they would be spending around 130 crores, and one in brownfield project in Bangalore where they would be spending around 25 crores, 25 to 30 crores. So that beyond this, there is no incremental capex on new facilities, and with improvement in profitability and better working capital management, lesser capital allocation, the free cash flows of the company is expected to consistently improve, and we expect that the return profile, improvement in the return profile stands out well in the coming years. So this is one of the best models in the healthcare space, and the current valuation of the company is around 13 times to 11 times EV by EBITDA. FY23 and 24 EV by EBITDA. So there is a potential upside of 20% from the current level. So we have a positive view on the stock with 20 to 22% upside from the current level, and we believe that this company will consistently perform well, and the management focus is there on consistently improving the profitability. So Khushi. So we expect company's revenue and EBITDA to grow at CAGR of 16% and 22% over FY 2022 and 25. I have already spoken about the drivers what will help company to achieve consistent revenue growth, and the drivers for the margins as well. So we are confident that company would see its return ratios to consistently improve in the coming years, as what has been targeted by even the management of the healthcare global enterprises. And considering that, we believe that this is one of the best play in the healthcare service healthcare services sector in India. So the current valuation of company is at around 13 times and 11 times FY23 and 24 EV by EBITDA. So we have a positive view on the stock with a 20 to 22% upside. We believe that the fundamentals of the companies have improved over the past 3 to 4 years, and we expect it to further improve with the strong focus of the management. So we believe that it is one of the preferred pick in the healthcare service, services sector. Thank you.